One of the most astonishing headlines to rock the financial world recently sprang from President Trump's cryptic tease about the possibility of bombing Iran. "I may do it, I may not do it," he declared, fueling a whirlwind of speculation across global markets. Why is this bold statement so significant, and how does it link to interest rates, the unraveling Middle East tensions, and the fate of the global economy? Today we will dissect every thrilling piece of this story. We'll dig into what truly happened behind the scenes and dive deeply into why mere words from the president can send shockwaves through stock indexes. In this journey, we will explore 5 central threads. First, how the threat of a new conflict might skew investor sentiment. Second, why the Federal Reserve's decision to hold rates steady could either be a wise precaution or a looming catastrophe. Third, the powerful role of tariffs in threatening economic balance. Fourth, the subtle but potent signals from housing starts hitting a 5-year low. And finally, the extraordinary impact all of these factors could have on everyday people everywhere. Our story begins with a market that started the day on a modest upswing. Investors had initially welcomed the idea that interest rates would remain stable for the near future. The Dow Jones Industrial Average hovered just a fraction above the flat line, while the Nasdaq Composite teased a tiny improvement. But then everything changed when word spread that the White House might seriously consider intervening in the brewing conflict between Israel and Iran, opening the floodgates of uncertainty. This narrative of flickering hope soon collided with chilling warnings from Iran, promising a fierce reprisal if the United States stepped over any red lines. The reaction among traders was immediate. Prices swung, forecasts reversed, and experts began speaking about the precarious walk we're on between cautious optimism and potential escalation. It might seem surprising how foreign policy announcements can carry so much weight in financial markets, but here we see a prime example of politics entangled in economics, weaving an especially gripping plot. Behind the scenes, central bankers at the Federal Reserve debated their own chessboard of monetary policy decisions. They published a fresh summary of economic projections, mapping out their best guesses as to where interest rates could land in the coming years. The median forecast for the federal funds rate at the end of 2025 was 3.9%, hinting at 2 interest rate cuts in that time span. However, officials did not see eye to eye on this path, and a handful projected nearly no change at all. The real question that haunted everyone was this: are we now in a new era of wait and see, where the desire to keep rates unchanged stems from a determination to press pause and observe how inflation evolves? Fed Chair Jerome Powell explained it as a prudent measure to study the near-term path of inflation before making any rash moves. "What we are waiting for to reduce rates is to understand what will happen with the tariff inflation," he stated, noting that the uncertainty surrounding tariffs adds to the complexity. Interestingly, the debate over tariffs is not just some arcane, behind-closed-doors chatter. It cuts right into the pocketbooks of average families, with the cost of these taxes on imports ultimately landing on the plates, purses, and wallets of regular people. While markets hesitantly embraced yet another quarter of no-rate hikes, a sudden swirl of rumor that the United States might become militarily involved in the Middle East conflict sent a chill. The possibility of missiles arcing across the sky in the region raised the specter of oil disruptions, jolting the energy market. The price for Brent futures stayed near the $76 per barrel mark, while West Texas Intermediate hovered close to $75. Although these price levels might not sound overly dramatic at first glance, the underlying tension is the real time bomb here. If a genuine crisis were to break out, analysts warn that crude oil could skyrocket, amplifying inflationary pressure at the worst possible time. Imagine the drama: federal officials delicately trying to orchestrate a soft economic landing, all the while being blindsided by a global energy crunch. It is the kind of nail-biting scenario that keeps traders awake at night, scanning every headline for a clue of what is to come. As the temperature around potential conflict soared, President Trump remained coy about the likelihood of authorizing any strikes against Iran. "Nobody knows what I'm going to do," he implied, leaving the world on tenterhooks. That uncertainty flashed through trading floors with the ferocity of a lightning bolt. Stock values twisted in real time as anxious whispers turned into glaring headlines. To some, it seemed like the dawn of a brand new front in the complicated relationship between the two nations. In the short term, what might happen if the administration greenlights an operation overseas? Investors fear it could trap the United States in a prolonged conflict, hamper global shipping routes, intensify existing supply chain tangles, and stoke crude oil volatility. But perhaps the biggest question is whether such a confrontation might overshadow, or even overshadow altogether, the Federal Reserve's methodical approach to inflation and economic stability. Yet let's not forget that the Fed's intentions are hardly monolithic. Their dot plot revealed diverging opinions on how quickly or slowly to adjust rates. If inflation remains sticky, particularly in the face of possible oil price surges, some economists think the central bank could reverse course and push for more hikes. Others believe that a slow but steady decline in inflation will allow those two interest rate cuts to slide comfortably into the next couple of years. And then there is always that wild card, the ripple effect of a large-scale conflict on global supply chains, trade policies, and confidence. At times like this, we see how a single jolt, from an unexpected tariff war to a sudden military escalation, can upend months of careful planning by monetary authorities. Speaking of tariffs and inflation, one of the more under-the-radar narratives here revolves around the cost of imported goods. With various tariff policies still on the table, domestic companies, workers, and consumers can feel the sting in different ways. Tariffs might drive up prices, strain corporate margins, force businesses to lay people off, or push them to relocate supply lines. Fed Chair Powell's acknowledgement that the cost of the tariffs has to be paid underscores the real implications of these taxes, well beyond the tidy spreadsheets of policy advisors. The suspense is in not knowing how deep and wide these effects will go, or whether we are merely glimpsing the tip of a much bigger iceberg. And the drama intensifies when major players hint that more changes may arrive without warning, adding an extra jolt of unpredictability, which can take a toll on everyday Americans who have come to rely on stable, predictable prices for their groceries and gasoline. But before we delve further into the leveling forces of policy decisions, let's pause on a particularly worrisome sign lurking in the economic shadows: the decline in housing starts. May's data showed that privately owned housing starts dropped by almost 10%, hitting their lowest level in 5 years. While some might chalk that up to seasonal adjustments or typical market cycles, others see it as a glaring red flag. Fewer housing starts mean fewer construction projects, which in turn translates to fewer jobs. The ramifications are broad, having a domino effect that reaches from carpentry and electrical work all the way to real estate, furniture sales, and more. Analysts from major financial institutions are now wrestling with how big a blow this might end up being to the broader employment numbers, especially if the slowdown persists beyond a single quarter. On this ominous note, one might wonder if the housing slump could become the Achilles heel of the economy. As we know, a robust housing sector typically signals economic vitality, but if new projects are stagnant, it suggests a deeper uncertainty about whether prospective homeowners are genuinely confident in their personal finances. Are potential buyers worried about mortgage rates creeping up, or do they sense bigger storms on the horizon? You might start to see how the threat of Middle East conflict can tie into an issue as domestic as housing starts, through the labyrinth of interest rates, inflation, and general public sentiment. If you are finding this pursuit of clarity valuable so far, please consider supporting this deep dive with a friendly show of appreciation. A simple gesture like sharing your thoughts or offering a thumbs up can help spread the word and ensure we continue bringing you the most riveting financial analyses around. Returning to the story of the Federal Reserve and its search for the perfect rate path, we encounter another subtle drama: the tensions between hawks and doves on the policy board. The hawks worry that inflation, emboldened by tariff shocks or an energy price spike, could roar back to life if the Fed waits too long to clamp down. The doves, by contrast, believe that an overly aggressive rate hike posture could crush the promising yet still tentative expansions in certain sectors of the economy, like technology, renewable energy, and healthcare. With the 2024 elections not too far away, the Fed also faces the challenge of preserving its independence, carefully skating along a line where any overtly political tilt could damage its credibility. One has to imagine how these conversations play out behind closed doors, as officials weigh everything from corporate earnings reports to joblessness rates to the always unpredictable headlines emanating from overseas. Meanwhile, the stock market itself is not just an idle bystander. Traders attempt to price in the swirling possibilities on the horizon: the risk of skyrocketing oil if conflict flares in the Middle East, the potential press down of consumer spending if tariff-induced inflation bites deeper, the partial relief of stable interest rates in the short term, and the intangible sense that the entire economy is perched on a delicate balance beam. In any given hour, the Dow Jones Industrial Average seesaws in response to even a whiff of new information. One moment, great cheer might greet a new data point, revealing that manufacturing is still humming. The next moment, gloom could set in if the White House hints at further trade tensions. As for the watchers of housing markets, they remain on high alert. The largest subcomponent of household wealth for many families is the value of their homes. When housing starts begin to shrink and completions stall, it can be a harbinger of diminishing confidence in future property values. This in turn can echo into consumer confidence. Fewer people feel comfortable making big purchases if they sense they are on shaky financial ground. The old phrase, "your house is your biggest investment," rings true for big swaths of the population. So whenever construction data wavers, alarm bells start to ring. Some analysts worry that if the homeowner's sense of security is rattled, it will hamper consumer spending, which in turn can hamper overall economic growth. The question lingers: might the Fed's steady approach to interest rates help or hinder the precarious state of real estate markets? The real puzzle is how all these puzzle pieces fit together in the months to come. On the horizon looms the chance that the United States could limit its involvement in overseas skirmishes, removing one layer of unpredictability from the already burdened markets. Alternatively, an escalation in the Middle East might stoke global tensions to a degree we have not observed in decades, with disruptively high oil prices and broader trade complications. The Federal Reserve, for its part, is trying to telegraph a calm, measured approach that can adapt to the data as it evolves. But the truth is that no central bank can fully prepare for something as massive as a geopolitical conflagration. Fed Chair Powell's statement that ultimately the cost of tariffs has to be paid lingers like a cautionary note in all of this. It speaks volumes about the interplay between politics and economics. When the Fed weighed the pros and cons of holding rates steady, it effectively signaled a pause to gauge inflation's trajectory. But inflation, in addition to responding to domestic employment and wage factors, can also be exacerbated by trade barriers, supply chain disruptions, and abrupt oil shocks. One can almost envision the Fed operating like a tightrope walker. One misstep on either side, acting too late or too soon, could send the entire economy tumbling. Yet for all its complexity, the Fed's approach rests on a fundamental premise that well-informed, methodical adjustments can steer the economy away from extremes. Looking more closely at President Trump's stance, we see a swirl of unpredictability. He has a track record of sudden policy reversals, swift announcements on international tariffs, and rhetorically driven market movements. For investors and everyday citizens alike, this unpredictability becomes another layer of risk that can hamper big business decisions or personal finance choices. One moment, the administration may speak of wanting to ease tensions and reduce taxes on international trade. The next, it hints at increased involvement in a foreign conflict, which could have a dramatic impact on geopolitics and commodity prices. Each shift fosters a sense of suspense among not only governments and corporations, but also wide-eyed families who watch the monthly bills stack up and wonder if a surge in energy costs or a contraction in job availability might be right around the corner. If we zoom in on housing again, we recall the data that privately owned housing starts are running nearly 10% below what they were a month prior, the lowest level in 5 years. That is not a small blip, nor is it an event that can be casually dismissed. Could it signal a deeper unraveling of consumer confidence, or is it just a seasonal phenomenon? Analysts are split. Some see an overhang of new construction from previous quarters, while others cite that completions are outpacing new starts, hinting at reduced optimism among developers. Indeed, if property developers sense a storm coming, be it from rising rates or from jitters about the general economy, they might put the brakes on launching new projects. That, in turn, trickles down into everything from steel sales to the local sandwich shop that feeds construction crews at lunchtime. And let's not pass over the potential job-related consequences. If you halt enough housing projects, you can see an erosion of work for construction laborers, framers, electricians, plasterers, and beyond. This job shrinkage can, in a worst-case scenario, ripple across the economy. A smaller paycheck for these workers translates into reduced spending in retail and entertainment, eventually affecting the bottom lines of a wide array of industries. It's a sobering prospect, and it underscores how an apparently narrow statistic, housing starts, can become a barometer for broad economic health. Exactly how the Fed's wait-and-watch approach might intersect with this scenario is one of the burning questions. Could cutting rates sooner, or possibly raising them, shift sentiment enough to jolt the housing sector back to vigor? Or is it too late for such a measure to matter? What is certain is that no piece of economic data exists in a vacuum. We find ourselves at the juncture of multiple storylines: the Fed's cautious approach, the tension-laden possibility of a U.S.-Iran conflict, the lingering uncertainty around tariff-induced inflation, and the ongoing pressure on oil markets. Each development changes the shape of the broader narrative, adding little twists of fate. And that is precisely why so many watchers are glued to every comment from Powell, every remark from President Trump, and every data release from the housing sector. The good news is that you do not have to navigate this labyrinth alone. If you are enjoying this panoramic exploration of how markets and global events interlock, feel free to subscribe for further deep dives. Sometimes, a single supportive action from you can help keep these in-depth investigations going strong. Let us return to how the threat of a U.S. strike on Iran might overshadow everything else. Even if it does not come to pass, the stage is set for further diplomatic wrangling. Iran has threatened to retaliate if the U.S. crosses a red line, potentially unleashing salvos of missiles aimed at American installations in the region. The fallout from such an action would likely extend well beyond the immediate front line. Freight routes, civilian travel, consumer confidence, corporate planning, and foreign investor appetite. These could all be shaken to their core if a single major incident were to light the fuse. The stock indexes, often regarded as barometers of confidence, might find themselves on an adrenaline-charged roller coaster of knee-jerk reactions and hopeful rebounds. That sense of living on the edge is precisely what leaves the market so prone to sudden zigzags in valuation, as we saw with the Dow Jones Industrial Average pulling back from a modest gain to a small loss in the day. Out of all the swirling uncertainties, perhaps the most encouraging sign is that the Federal Reserve stands ready to respond if the economy lurches off course. Whether that response is timely and precise is the million-dollar question. If conflict does erupt, or if oil surges well beyond the $70 bracket, the Fed might pivot in an emergency move to quell the inflationary spark. Alternatively, a swift resolution to Middle East tensions could bring relief to investors, offering a window for lower rates as the economy stabilizes. For everyday households, the outcome remains unclear. On one hand, stable or lower rates can keep mortgage payments in check, encouraging families to invest in real estate or simply manage their budgets with more grace. On the other hand, a spike in energy costs can swiftly devour any benefit of a stable mortgage, especially for households operating close to the edge. Meanwhile, corporate leaders track the cross-currents of these events in their boardrooms. From small factories to multinational giants, every strategy must account for the potential costs of tariffs, the possibility of souring international relations, and the chance that consumer demand might wither under too much strain. The hope is that a balanced approach from the Fed, one that fosters business confidence via predictable credit conditions, will offset some of that risk, giving companies room to expand. Yet each corporate enterprise must also weigh the prospect that a major conflict could upend everything from supply lines to insurance costs. Engineers and risk managers may find themselves scouring every corner of the globe for safer production lines and distribution networks, anxious to avoid the slightest hint of disruption. In the midst of all this, average Americans continue their everyday routines, heading to work, paying bills, and perhaps pondering the wisdom of buying a new home in a market overshadowed by historically low new starts. If there is a silver lining to the Fed's steady stance, it could be that consumers see stable borrowing costs for a bit longer, allowing them to reassess big financial decisions with a sense of relative calm. Yet no one is entirely immune to the swirl of unfolding events, and the unpredictability swirling around possible Middle East involvement only heightens the tension. Sooner or later, the drama behind all these headlines, rate decisions, conflict threats, tariffs, and housing fears, will come to a head. Perhaps we will see a peaceful resolution in the Middle East and a gentle path to lower rates, a scenario that would almost certainly be welcomed across the globe. Or perhaps growing tensions and surging oil prices will unravel the best-laid plans of policymakers, forcing an entirely new approach. As uncertain as the future might be, this storyline remains as gripping as the best thriller. One day, the markets might cheer at the promise of a truce, only to recoil the next at an alarming new statement. The one constant is that we will continue to watch, endeavoring to make sense of how the biggest players on the global stage orchestrate their intricate dance of power, policy, and finance. The final question is this. In a swirl of speculation, do we as citizens and consumers have any direct say in how these events shape our lives? Perhaps in small ways, we do. We can demand more transparency from leaders, push for balanced approaches, and keep an eye on local economic indicators. We can expand conversations beyond the headlines so that average households understand the connections between foreign conflicts, Fed decisions, and the cost of building new homes. That is the importance of telling this story in a way that resonates beyond the financial sector. We all have a stake in how it turns out, whether in the form of stable gas prices, the prospect of affordable mortgages, or the intangible sense of security we get, knowing that a major conflict might be averted. So, keep in mind that each jolt of news is part of a bigger tapestry, one that includes the Federal Reserve's balancing act with interest rates, the precarious tension with Iran, and the teetering housing market. Even though markets sometimes look like cold, impersonal machines, they are, in truth, emotional barometers of our collective hopes and fears. When we hear the slightest whisper of war, we see prices react. When the Fed chooses caution over confrontation, we see a brief sigh of relief. Whenever international relations tilt one way or another, we brace ourselves for what's next. And ultimately, that's the essence of why these events matter. They reflect who we are, our ambitions, our anxieties, and our enduring drive to find stability amid a swirl of unknowns. Thank you for accompanying us on this intense ride through the shifting landscape of finance and geopolitics. Remember that your engagement can help these explorations reach a broader audience, so feel free to share your enthusiasm or leave a supportive comment if you found clarity here. The world might be unpredictable, but knowledge and perspective can help us all navigate the storms ahead. Stay tuned as we keep our eyes fixed on the next wave of developments. Future revelations may come swiftly, whether they concern interest rates, a potential peace deal, or hints that housing starts have begun to recover. In any case, we will be here to analyze, explain, and hopefully bring some excitement to topics that matter profoundly to each one of us.